let's discuss portfolio management, and not on a minute scale, but on a broad terms. If you're looking for some general advice on how to build a portfolio of investments for the long haul, and again, with my suggestion, think of 50 years at a time. It is my advice that you look at creating an overall portfolio in 3 sections. The first section would be what I call certainty money. What is certainty money? It is money you put into some vehicle, some ability to continue growth or gain growth on your money, where you know what it will be worth within a very narrow range in 10 years, 20 years, 30 years, 40 years, even 50 years. Why? Because if you put your money into, as seems to be the case with most people, 401k plan, mutual funds, stocks, bonds, whatever, you know there will be volatility. You know there will be ups and downs. And if you know that's going to be the case, think about this. If the market collapses when you're 82, will you be able to pay your bills? Will it happen when you're 82? I don't know, but you don't either. The idea of knowing exactly how much you will have within a very narrow range, shouldn't say exactly if I say in a narrow range, should I? But within a narrow range, so that you know you can pay your bills. Well, that's the first section of the portfolio. Again, we call this certainty money. What vehicles would you use for that? I suggest participating non-direct recognition whole life insurance as the first step, especially if you have a family, because that'll double as a way to protect them in case something happens to you. The second vehicle I would use is annuity. Now, if you're 25 or 30 something, probably not thinking annuities, although you might find it quite helpful. But when you get older, you will. Last thing you want to do is outlive your money. What does an annuity provide that other investments cannot? Well, you're placing the responsibility for that consistent income source, for that consistent money flow on the shoulders of an insurance company, which is in a regulated industry. It's a regulated company with a constant business model. It's not subject to the ups and downs of the stock market, and that's a huge plus for certainty money. We'll get into that more in the future, and if you have a question, let me know. The second section of the portfolio I refer to as the wealth accumulation or legacy money. That's where you put investments or money into the stock market, bond market, alternatives. That's again recognizing there will be ups and downs. So putting money in there, you know that there will be downs when you least expect it, well into your old age. You don't know when, you don't know to what degree, and you hope, fingers crossed, that you can make some extra cash in there, build some wealth, but you cannot rely on it to the same degree that you can on certainty money to pay your bills at any point in your life. Now, the third section is throwaway money. That is, you get a hot stock tip from Uncle George. You don't want to upset the family. You put $5,000 into the investment knowing that it can go to zero. Not because it's Uncle George, although who knows. But the idea is certainty money is at the base, wealth accumulation in the middle, and throwaway money at the top. Now, what are sizes for these sections? That depends on you and your cash flow and your risk profile. But generally speaking, the first section, certainty money, is going to be somewhere between 25 and 75% of the portfolio. For some people, risk averse, 100%. The second section would be somewhere between, let's say 75% down to 25%, the opposite of the certainty money. The throwaway money, that again, up to you. Could be very little. $5,000, $10,000, $1,000, $500. But throwaway money, that's where you assume that even when you put it to work, it might not come back. Well, that's the all-weather portfolio. You take it as you wish, may or may not follow my advice, but it should help you understand that other portfolio models where there is some sort of a calculation to determine your risk profile, think of it this way. Do you think your investment advisor takes any risk on your investments? No, you do. Do you think Wall Street firms take risk? If they have a trading division, sure, to that degree, but within controlled amounts. Do you take risk? Everything that you invest in stocks and bonds, well, you may notice that if you ask an investment advisor on Wall Street for a guarantee as to the results, you will never get a guarantee. You find an investment advisor that gives you guarantees, they can lose their license, their job. That's a problem for them. What I'm dealing with in that certainty section is guaranteed money. Guaranteed to the degree that you can guarantee from an insurance company in a regulated industry. But that's in black and white. It's important to recognize your risk profile, that is how much risk you can handle. And just because you're 25 doesn't make you a big risk taker by age. You might be, but don't assume that just because you're in your 20s you can afford risk. It means, can I sleep at night if I know that I can lose money, my hard-earned money? Can I sleep? Can I live? Can I handle years of not having the cash that I threw into an investment that went to zero? Is that a possibility? Absolutely. Be aware that the people that are the wealthiest in this world haven't done it through investments. They've done it through building companies. They've done it by handling non-risk positions. Funny thing about Wall Street, the wealthiest people on Wall Street aren't doing it because of taking risk. They're doing it because they're taking money and using it, putting other people at risk. Funny about that. On that note, the 50-year plan is important and the all-weather portfolio right up there with it.